Happy Thursday, everybody. Thank you guys so much for joining me. It is a beautiful day outside. I am so happy that we have sunshine this week. It has been a little bit chilly down here, though. We're having our second winter as we know it in the South. We always get this wave of spring and it gets us all very excited. And then, nope, winter comes right back around for a little while. And I don't know if any of you were here in 1993. I was. I've been born and raised here. So we had the blizzard of 93. And that was actually this week that happened back in 1993. So I don't know why Georgia always decides to just kick us one last time with the cold. We're in the South. We like the warmth and the heat. So hopefully after this week's frigid temperatures, because to me 28 is like Arctic. I'm more of like a 75-ish kind of girl, and I might need a sweater with that. So I know you Northerners are thinking, wow, Ashley, get a grip. But so yeah, thank you guys so much for joining me this week. I'm super excited to go over some things. I want to make sure that everybody is educated and not just going off of what news media is talking about when it comes to the Silicon Valley bank collapse. So take a minute. Tell me, where are you joining us from? Where is everybody coming from today? Oh, you remember that blizzard as a kid? It was crazy, wasn't it? I remember vividly, um, my mom, obviously everybody was off work and we were in the South. We didn't really have things. And so my mom got a laundry basket and we went outside and played in the snow. And that was my sled. So yeah, we had a fantastic time during that time because I don't think I'd ever seen that much snow. So good times. Where's everybody joining us from this evening? I am extra excited today because it's my daughter's 13th birthday. So I don't know if I'm, coming or going right now because I have a teenager now. She's my oldest. But I'm super excited to celebrate with her. So y'all, shout out to Addison. Happy birthday. So let's dive straight in. Let's dive straight in and just take a look at what is going on with the Silicon Valley. So if you take a look at everything that happened this week, a lot of people completely freaked out because the bank collapsed. And so I wanted to dive in today to talk about what does that even really mean? Because I don't think a lot of people actually understand how can a bank collapse. And I've had multiple discussions this week with people about why the government came in very quickly and just kind of swooped in and saved them more or less. And once you start looking into things, it definitely makes a little bit more sense. I can't say that I agree with everything, but that's why I'm not in government. So I'm in real estate. So I was going to share with you guys right here. If you take a look at this. So earlier this week on March 10th, the lender suffered from an old-fashioned bank run. Now, I don't know if you guys remember or not, but if you ever watched the movie It's a Wonderful Life, there was a scene where there was an old-fashioned bank run and literally everybody in the town ran to the bank and they were like, I want my money. Give me my money. Mr. Potter's coming and he's, going to take things from us, and they wanted their money out of the bank. And the way banks run is they're borrowing my money to pay you, and then they're going to take your money and they're going to pay John, and then they're going to take John's money and they're going to loan it to Kim. And that's just how banks work. So if every single person that has money in the bank, think about somebody like Wells Fargo, they've got banks nationally. If every single person came and said, I want every dollar from my account given to me, there's not enough money to pay back all of those people. So that's a bank run. And so that happened here at the bank, and they didn't have the money. So you have to think about what goes on with this, because a lot of this came from, and we'll talk about it here, it was one of the biggest US lenders to fail since the 2008 global financial crisis, which obviously a lot of us lived through that, crash. But we came back from it. So why did it actually happen? Like I said, they just did not have enough cash to pay the depositors. So they had to close. The long answer, though, is this actually started a while back. And so this bank actually was one of the biggest lenders to some of the tech companies that were in California. It was a major backer of new businesses. And unfortunately, a lot of those businesses failed over the last couple of years, whether it was due to COVID or whether, the tech startup out there has been struggling. A lot of them have had to let people go. And so that had a lot to do with it. And so when they lend money to companies and then those companies don't succeed, they were banking on that to succeed, and now they've lost that money. And then on the flip side of that, they also were banking on the real estate market in a lot of ways because they were a backer of Open Door. And then when the Fed kept hiking up rates and hiking up rates and hiking up rates, and the market pretty much came to a screeching halt last year. Oh my gosh, did you guys see that? I almost knocked over the whole desk. Last year, when the market came to a screeching halt, that kind of put their money on hold as well. And they lost quite a bit of money. So if you take a look here, let's read it together. The bank recently said it took a $1.8 billion hit on the sale of some of those securities. Up here, it was talking about some of the securities with the rapid increase in interest rates in 2022 and 2023 caused the value of the securities that they had backed to plunge. And so basically, it's kind of like if you have your money in a 401k and all of the stocks that you had plunge, well, you lose the money. That's exactly what happened to them. So it prompted the venture capital firms to advise their companies all of the money that they invested to go pull out with that bank. So what happens? Same thing as It's a Wonderful Life, except it was not a wonderful life for these people because the bank had all of these people calling and saying, I want my money, I want my money. Well, after so many people do that, they don't have any more money to give. And so they had to close. And so a lot of the people, the clients that had money there were thinking, oh God, I'm not going to get paid. I'm not going to get my money out. And it's funny, I learned Etsy. I actually learned this earlier today, talking with somebody that has a business on Etsy. Etsy is one of the people that, one of the companies that works through them. The Silicon Valley Bank pays the people that have businesses on Etsy. And so a lot of those people were panicking, am I going to get paid out of this? And so the good thing is the lady that I was talking with did get her money, but she also said, I'm not one of the big sellers on Etsy. I am a dime, in the little sea of all of these bigger fish. And so she was hopeful for, some of the people that have bigger businesses on Etsy and hopeful that they're going to get paid out of this. And from what I've understood, everyone will get their money and will get paid. It's just a matter of time because currently the federal government has stepped in and they're going through everything and they're looking over everything. So it's going to be a matter of time before they get everybody paid out. So let's take a look at this. Are the deposits now safe, right? It is typical for the FDIC to shut a bank down on a Friday and have the bank reopen the following Monday. In this case, they've already announced that the bank will reopen on March 13th with a new name of Deposit Insurance National Bank of Santa Clara. At the end of 2022, the SVB had $175.4 billion in deposits. $175.4 billion. That is crazy. So for depositors with $250,000 or less, you have access to your money immediately. So $250,000 or less, you have access. Anything over that, you don't have access to. You would have up to $250,000. But anything over 250,000, sorry, you can't have that right now. So can you imagine? And I know that this is something that all Americans have thought of, and that's why we have a lot of people that I call nickname, the mattress cash people, because they literally have mattresses stuffed with cash, or they've got it stuffed in a drawer. I don't necessarily think that that's the answer, but this is a huge reason why you should always have your money diversified. It should never just be sitting in the bank. If you have so much money sitting in the bank, it's not a smart move, in my humble opinion. Now, I am in no way a financial advisor. I have one, and he's told me this for years. I can't say that I've always listened, but I also don't have multi-millions in the bank that I need to be concerned about either. So, so many people, if you really want to look at, the wealthy, they don't have it all just sitting in a bank. They have their money in stocks. They have their money in real estate. That may look like investment properties where they're renting them out. It could be in property management. It could be in commercial properties. Maybe they've bought, a duplex or a quadplex, an apartment complex. Maybe they have a commercial building, a storage facility. You can put it in stocks like we just talked about. A Roth IRA, I've heard, is, one of the safer bets. So there are many ways that you can take the money, put it in somewhere else, and diversify that money so that you're not having the money just sit in the bank. And then God forbid something like this happens again, because I hate to say it, it will happen again. It's only a matter of time, because we can't keep, well, how does that saying go? You rob Peter to pay Paul. Is that right? Um, so yes, that's the thing. And so thank you. It's going to happen again. It's absolutely going to happen again. So make sure that you have your money diversified. I'm going on a preaching rampage here. I'm sorry, guys. Um, so if you look, what was the last US bank to fall prior to the failure? The most recent bank failure occurred in October 2020, when the Alameda State Bank in Kansas and the First City Bank of Florida were taken over by the FDIC. Both of these were relatively small, with about 200 million in deposits combined. That still sounds like an awful lot of money, but obviously we're not looking at the billions that we were looking at over there. So then if you look here, SVB was the biggest bank to fail since September 2008, when Washington Mutual failed with 307 billion in assets. And they really fell after kind of the global financial system, after we were looking at basically the real estate market tanked in 2008, and it was because of bad lending. 2005, 2006, 2007, the writing was on the wall, and so many people saw it coming, but it was like a rat race. You couldn't look away from the disaster that was about to take place. And when the real estate market collapsed, it took down the bank with it, because people lost so much money. But thankfully, this bank closing, the SVB, was not because of faulty lending, was not due to the real estate market directly. That did obviously have an effect, because when the interest rates started going up, it really threw a curveball to some of the financial investments that they had made. Oh, hey, Anthony. Oh, happy birthday, Addison. Thank you, Anthony. I heard you guys have got some things going on in your house too. I hope everything's going well there for you, because you've got young ones, and man, that's a whole different boat, but you'll get to where I am very quickly. So let's take a look. Is there any risk that more banks might fail? I know that this is a big question in everybody's mind. So at the end of 2022, they were the 16th largest bank in the US. 16th largest, but that's just 0.91% of all banking assets. That is so minor, absolutely so minor. So having said that, it does highlight the risk that many banks have in their investment portfolios. If interest rates continue to rise, and the Federal Reserve has indicated that they will, the value of the investment portfolios of banks across the US will continue to go down. So obviously that is a bigger risk. However, if you guys have been watching interest rates this week, and obviously it's my job to do so, they've actually gone down. because of all of this craziness, the interest rates this week have gone down. Um, and when the CPI report came out this week, it wasn't horrible. It wasn't fantastic, but it wasn't horrible like the last one. So that is a little bit of good news. It's a little bit of, I don't want to say light at the end of the tunnel, but it is something to be considered because anytime the interest rates are coming down, and it's something that they have to look at from the Fed because they're two totally different entities. However, they're kind of messing up each other because as the Fed keeps raising the rates, they're hurting the banks. And so then this happens. So, I mean, what is one to do? Do you lower the interest rates to make sure that the banks don't end up falling, collapsing? But then you're risking inflation coming in again, which it hasn't really stopped greatly. I don't know if any of you guys saw on my post on Instagram yesterday, but we had a client looking at a house, $970,000. We ended up going in, we were going to make an offer. The listing agent, I always call and ask, any details. Do you have any offers? If so, are they over asking price? I try to ask yes or no questions so that they can give me as much information as possible. And I asked her, do you have any other offers? She said, yes. I said, do you have more than one? She said, yes. I said, more than five? No. Okay. So we're somewhere between 1 and 5. I said, if we come in at asking price, do we stand a chance? Absolutely not. I said, okay, if we were at 970, list price, if we come in at $1 million, do we stand a chance? And she said, most likely. The hard part for us was we did have a home to sell contingency. So we tried to sweeten the deal a little bit. We went in at $1 million. We cut down our contingencies as low as we possibly could, but while keeping those still in. And we submitted our offer. And I felt good about the offer. And my client pretty much just said, people always say, well, what's the best offer? The best offer is the one that you're comfortable with. I always tell you when you're making an offer, if you're in a multiple offer situation, because nobody likes being in a multiple offer situation, unless you're the seller. And then you're like, yay for me because I've got all these offers. But if you're the buyer or the buyer's agent, the listing agent isn't going to tell me what the magic number is because that's against the law for them. They represent the seller. They would be hurting themselves, hurting their seller. So by answering as many yes or no questions as they can, and that's why I call and just ask, is there a closing date? That's really important. Do they have another home that they're moving to and we can align with that? Anything that can help sweeten our deal without it always being financial. And so we did all of those things. And I told him, I said, you make the offer where if they call and say, I'm sorry, we went with somebody else's offer, that you're not upset about it because you went with the best offer that you were willing to put out there, that you're not regretting spending too much money, but you're also not regretting that, oh, well, I would have gone up to, if you would have gone up to, then do that now because you can always renegotiate or terminate during due diligence. You can't make an offer again later. So he said, I'm at the offer where I'm not going to be sad if I lose it. Like, yes, I want the house and I will be upset that I lost the house, but I'm not going to be upset with my offer. I'm not going to have any regrets. And she called me the next day. God bless. They had 9 offers come in on that house in Kennesaw, over $1 million. So the house was listed at 970. We went in at $1 million and we lost because 4 out of the 9 offers were higher than ours. So we came in 5th place out of the 9 offers. So the market is still strong. The homes that are selling, because here's the tricky part, you're seeing homes that are sitting on the market. There's a home here in Sugar Hill, just down the street, cute little ranch, great neighborhood. That home has been on the market, I would say 5 months. I drive by it all the time. It's overpriced and it does need some updating on the inside. It's not horrible, but it's also very just old looking, old fashioned. And so the homes that hit the market that are updated, that are ready to go, they're move-in ready, um, and priced appropriately for the market, those are the homes that are selling still within days. Many of them multiple offers. I told you guys last week about the multiple offers that I was in the $300,000 range. That range is consistently seeing more multiple offers. The higher end range, we had really started to see more of a slowdown, but it seems like we're starting to see a lot more because we're not seeing homes coming on the market. The inventory is so incredibly, incredibly painfully low. But what's happening is a lot of the people that have these low interest rates, if you own your home and you have a 2, 3, 4% interest, people are staying in their homes. They're staying in their homes. And what I've started to realize is a lot of people have thought about getting into investing. And when I say getting into investing, not necessarily getting into it in a major way, but they've thought about, I want to buy an investment property. And so instead of staying in their current home and then buying an investment property, what a lot of people are doing is they're keeping the home that they're in as the investment property with a lower interest rate. And now they're going to buy the home that they're going to live in at the new interest rate. Because then the money that they can charge in rent, because rent has gone up so high, the money they can charge on this lower payment with a lower interest rate, the money they can charge with that rent, it offsets this new purchase for now with the higher interest rate. And then next year, when interest rates readjust, they can refinance and get a lower rate. And so now they've moved into the home that they're going to be staying in, and they already have their investment property. So it's very interesting. It's kind of flipping the script where most of the time you see people get their dream home or whatever you want to call it, and then they get their investment property. A lot of people are getting their investment property, living in it for a minute, and then keeping that and moving into their dream home. And I have to say, it's a smart move. So for a lot of the younger generation where you don't have kids yet, you don't have things that are tying you to an area such as school districts or friends, things like that. It is super smart going back to the bank, diversifying your funds. If you have funds and you can go ahead and get a home, a property, it may not be your dream home. Live in it for a year or two, keep it, hold it, go on to the next property. If you need to pull out a little bit of money from there to put down on the down payment for the next home, do that for 2 years, move to the next, and keep doing that until you have renters in each of those. And now maybe you do have kids and you want to settle down, and so you end up getting into your dream home. But then you have other properties that are paying for that home. So it's very, very smart. Anthony and I were actually talking about that as he's, thinking about, making a move down the road. His kids are still younger, and so that's something that, he has the opportunity to do. I did want to share this with you guys because it kind of made me laugh. Right here. So, need money to make loans to people who need money. So why most of the world's banks are headed for collapse. And it just really started to make me think modern banking emerged from the goldsmithing trade of the Middle Ages. And so, like, how old fashioned is banking? And a lot of people have talked about, we've had crypto coming and we've had other, on like banks have gone online now. You've got Ally Bank, you've got other ones that are like that, where there's not a brick and mortar, it's all online. And so are we going to see more of a shift in the way that banking is done? It's going to be interesting to watch what happens with that, because I do think that there's a lot of disruptors in this market and what that looks like. Anthony, if rates continue to decrease, are we going to see prices raise like crazy in the summer? That's a great question. And the truth is, I don't have a great answer. I do not think that we're going to see like we did the last 2 years. And I'll tell you why. The last 2 years, what happened when we had the pause of the pandemic, nobody could get out. So people couldn't look at houses. They had to, so anybody that was looking at houses, it was kind of like getting in line for 3 months, right? Because no one could get out and go look at homes. So the people that would have purchased in March, then April, then May, then June, all of those people got pushed and pushed and pushed. And so it was like, have you ever been to a concert and everybody's lined up and then they open the doors to the concert and everybody goes rushing in? That's what was happening, right? All of these people had been waiting to buy, waiting to buy, waiting to buy. And then they were like, okay, you can go outside again. So everybody was like, okay, let's go look at houses. And so you had this rush. Well, also during that time, builders couldn't build. And so all of the new construction that should have been being built wasn't being built. And not only was it on pause for those 4 months, it's really been on pause since like 2008, right? Builders did not really start building spec homes, like homes that you could go and say, hey, I need a home in the next 45 to 60 days. And they were like, great, we have this one right over here. They didn't do that because that's what they were doing in 2006, 2007, and they lost their rear ends on it. And so they were like, nope, until you come and you put down a deposit and you say, this is the house I want, here's $50,000 to put this countertop in there. They weren't building them. And so we had so many buyers that were back ordered, basically. And then on top of that, you had all of the wood and windows and things that were floating in the ocean somewhere because it had been shut down and they couldn't get them here. And so it was just catastrophic all the way around. So I do not think that we're going to see the prices that we saw over the last couple of years. I'll say that up front. I do think we run the risk, if rates come down, that we run the risk of having multiple offers because more buyers are going to come out. At the same time, I think that it may entice some of those sellers that do want to sell, but they're like, I don't want to sell because then when I go to buy, I've got this high interest rate. It may entice some of those sellers to say, you know what, they've come down enough. I'll go ahead and list my home and I'll make the move. And so now you have more inventory hitting the market. And so that's what I'm hopeful that we're going to see. So it is going to be a very, very interesting year. I don't know what this year is going to hold. I wish I had a crystal ball and could look at it because, man, that would be fantastic. But only time will tell. So I am going to jump off, see my baby girl. I hope you guys have a fantastic week, and I will see you next week.